Hello from the children of planet Earth. Hello from the children of planet Earth. Hello from the children of planet Earth.
Yo, what's up, everybody? Good morning. Welcome to the stream. Exciting day today. Futures trading is live. I'm going to be throwing my first trades out there on the platform. This is years in the making. I'm so excited to get to this stage. So all things go well, I'll be releasing to the public this week. It's exciting. You got a connection tab. You should see it now. That's correct. For now, it should see your Discord on the connection tab. So make sure you connect your Discord first and foremost. And then as soon as I make sure everything in future is looking good, make a few trades, we'll start releasing it to everybody here. Go, go, go. All right, market opening pretty good. Got a DD band flow. That's something I'm going to talk about today. I'm going to make sure I get that open front and center for everybody. Hold up. DD band float is one of the things we talk about. It's in our cheat sheets. Make sure you grab it. I will open it up. Open the link. Get that guy right there. Okay, cool. So basically, we're going to open with a really high DD ratio, which is going to show bullishness in the market. But we came very close to tapping the lower band on the Nasdaq. So if you do touch that lower band, we all know what that means. The market's going to be sit out day. If you have DD band float failures, walk away, call it a day. VIX is still treading water above that triple B level in futures. That's going to be volatility induced overshoots and pivots, et cetera, building a position. We need to get that VIX below 14.4, that front month contract in futures. Hopefully so pretty soon. All right, y'all. Market opening in 13 minutes. We're a little early start today. Just kind of chilling. Take a look at things I'm talking about. Here's your DD float. You're going to want to see this short level here in the Nasdaq. You want to see this not touch today. You want to see it have some kind of magical floating effect off of these green lines. We call it the DD float. Happens all the time. I'll show you what that is right here. When you have a positive DD ratio, but futures trading lower, it's a huge discrepancy there. And when you look on my chart, we even draw out the little magnets to make it look fun. DD float. It's area futures risk. The market, they're not going to detach that far from each other. That's what we're talking about today. This is one of the things that we do talk about. And if you do, so normally you're going to see just some kind of repulsive force to keep futures on track from not trading too far below where the stock market's expected to open. This is a really, really, really cool technique. The DD is going to come in today probably in the 90s like it's been every day. So it's going to want as hard as it can to fight. There's going to be like an invisible layer of protection that's going to keep the market from touching that lower band. I love float. We have a whole cheat sheet on it. It's such a big deal. And as you can see in the Nasdaq, it's certainly not becoming unstable and irrational overnight. See how cool that is? You learn something new here every single day. So market is rational enough, but if we trade in the morning and we touch this level, we call it a failure. And those float failures aren't a good sign of the market staying rational and calm. Clearly you're going to want to see this not touch that lower band. It's one of those cool cheat sheets over here. we're one step away from automating the DD process in the platform, which is great. Since future data come through nice and clean. VIX, we're going to see VIX below 14.4. So this is going to be something I want to see continuing for the month in the bull market, but clearly we're not getting that VIX decay. It is earnings season, and there's a little bit of shuffling of positions around. So I still think we're bullish to double top the market through at least August monthly expiration. We're talking about the positional data today to kind of support that. And here's my DOM because futures trading is live, everybody. Check it out. Got my account connected, got everything connected. I'm up here. Taking a look at all the, let's see where the DOM is. Now I need to, wait, 45.98, okay. So one of the things, there we go. Oh, auto centering your DOM. This is exciting. So we're gonna have the last few bugs here. And there's a strange artifact that we're still trying to work out. The DOM apparently is writing twice, so that's kind of interesting. That's the last little bug we're trying to figure out. So I got two ladders, which is interesting. So let's just watch the top one, I guess. It's really nice to see this finally. We're doing our due diligence to make sure our platform is ultra stable and ultra clean, but. Last little artifact there. I have it started off set up to do micros, so let's see if I'll just fire off a micro today. Make sure everything works nice and clean. Got my SPY here, QQQ here, my alerts here. We're ready to go. Market up in 10 minutes. Take a look at the morning news. Nothing really crazy overnight. A little bit of selling in global markets. Let's talk about today's effects. Really nothing. Wait. Oh, the OPEC came out today. Production numbers. I guess that was this morning. Chicago PMI came out. Make sure I'm in my right time zone here. I'm like, wait, that's not today. That was yesterday. I'm like, today I was like, wait, I remember talking about that yesterday. Jolts, that's today. These are the bigger things you're gonna want to care about. This is gonna be a catalyst today. Jolts are gonna be something that's gonna indicate the health of the job sector and the economy. There's a lot of things we've been talking about. The idea that the jolts have been trending down. These are job openings that are gonna be filled in the 30-day window. If there's work available and companies are actively trying to hire and they can hire somebody and that person can start within 30 days, that's considered a jolt, a job opening from the Labor and Statistics Bureau. So why are jolts going down? Well, jobs, essentially, if jolts are going down because people are getting laid off, it's because companies are eliminating jobs. But if jolts are going down because, jolts are going down and unemployment's going down or jobless claims are going down, it means people that were unemployed are getting their jobs back, and that's exactly what we've been seeing. So jolts are not going down because companies are trimming the fat anymore. Jobs are going down as people are going back to work, and we'll see that on Thursday's data. Thursday has always, every week has jobless claims, and we're going to see those this Thursday, and non-farm. Let's see, keep an eye on that, and initial and continual. Just reviewing the data, this is going to help us predict what the Fed's going to do. We always do this. The initial jobless claims, you can see like the waves of layoffs that we've had. The waves of layoffs are deteriorating, at least the ones from this last bout. That's still looking good, and this is last week's data, by the way. The continual jobless claims, so it's basically this is what I'm showing you right here. This is matching the jolts, people that were unemployed and continuing to file for unemployment insurance. There are fewer and fewer and fewer of those people, which match the jolts coming down. So what that means is that people are going back to work. Yay, how about that? You don't have a recession mechanic when companies are hiring people to come back very rapidly in a 30-day window. So that's exactly what you want to see for a healthy economy. At least for now, things are okay. We have like an eye in the storm. Is this bear market going to continue and pick up somewhere? Yes or no? Everyone can debate on that. I'm bullish to the 5,000 plus S&P level by summer of next year. Could be even higher. I think we straight shot the double top the market within a month's time. This is a very rapid rally we're going to see. And from there, I believe that the market's going to double top, and then finally all that selling pressure is going to come in. So if you want to know my opinion, now again, this is just speculation. It's hard to say this, but you know, we sold off. Actually, let me kind of shale this. This is what I'm going to draw the market the way I think it's going to happen. We're running a factory over here. All right, here we go. Ready? Like, we're going to go straight here, and I think that the market's going to psychologically respond. I think it's going to be something like that. But then I think, you know, it's going to hang, and it's going to hang, and then obviously we're going to exhaust before any signs, and this is the questionable part. This is going to be next year. I think at least to squeeze the rest of the shorts, we're going to go straight up and double top. Yeah, your platform connect to Discord. Nice. Now, what that'll do is automatically adjust your roles. We wrote a custom Discord bot to connect to your Rocket Scooter platform. So that's actually one of our cool releases that just came out. Everyone should go connect your Discord to Rocket Scooter. All it's going to do is just connect. Nothing's going to change yet. But as we release features for the bot, the platform can talk to you, send you alerts, send you text alerts and things just through that block. My screen shouldn't be blurry. Maybe change the resolution on your YouTube settings. Bottom right under the screen. So I really think that this is what the market's going to look like. I think we're going to go straight up and double top. And I think there's going to be some psychological pressure at that point. But I think there's enough bears waiting to squeeze. I don't know how much we'd sell, but I would say that it would make an attempt to fill this gap. But I'm bullish enough to think that we keep going. This is what I really do think the market's going to do. It's hard to guess that that's going to happen, right? To take a guess. And let me show you, it's not just speculation there. The monthly map is showing an increase in the bear positioning. I'm just going to kind of show that real quick. But the bulls are holding strong. This is something we talked about yesterday. Let me show you, I can put that up here real quick. Where's my... Let me see my layout real quick. Okay. Market opens in 4 minutes. Oh, market's not even open yet. Well, let's wait till market opens and we'll run a monthly map. So at least for now, the economy's safe enough. And if you read the words of the Fed, this is something we've been talking about lately. The FOMC is saying that they're kind of working this Goldilocks zone. I wrote a thesis I put on Twitter. They were kind of repeating what we saw in 1984 to 1986. Just a little 1978 to 1984. A little icebreaker. It was a period of rate hikes. It's a period of 2-year, 10-year yield curve inversion. Same stuff we have now. And it preceded the largest rally we've seen in our lifetime. Market rallied for a year, sold off for a year, and then rallied for, what, 16 years after that without even stopping. The SP went up 1,600% at the end of it all. Now, the yield curve inversion, bears love to use that. Now, when the yield curve is shifting, that's bearish, but when the yield curve inverts, it doesn't necessarily mean the market's bearish. It means that there is very little demand for the 2-year treasury note versus the 10. People use that as a recession indicator. But it means that people aren't fleeing to safety in a short 2-year period. Why would they not be doing that? Probably because the market does not seem to be bearish in the next 2 years. Most people are perceiving it to be somewhat bullish, and this tech boom is being in this kind of progressing momentum. That seems to be more appropriate, especially when there's going to be guaranteed rate hikes and guaranteed inflation. Any short-term yield from a fixed income investment, it's immediately toxic. You're going to lose money. Both of those routes Because if you're getting a fixed income that you know is going to lose 5, 6, whatever % due to inflation, you're already taking a loss out the door by having a cash-based trade. So people are seeing that the net loss in equities is much less than net loss in treasuries, which is why you're seeing an avenue of window dressing for the end of the month trade yesterday, why the market rallied in the last couple of minutes, because people are putting equities on their books and not cash. You can see that, and that's why the yield curve's slipping. Well, that's just my opinion. I'm probably one of the few people that see that as not being so bearish. I think bears looking for every indication they can, and people don't want to buy the 2-year note. Well, it just means that there's no rush to flee to safety in a 2-year window. And you can see that from the rapid bullishness and the commitment of traders showing that the market is just not sitting there with an appetite of bearishness. I don't know where my commitment of traders is right here. The asset managers are longing equities, longing equities, longing equities, longing equities, and keep going. So they're throwing their money as fast as they can into the tech boom. They're not out there playing the safety bet. All right, let's get our, see, we got our liquidity maps going. Wait, the DOM is not auto centering, huh? Oh, this is the pain in the ass. Okay, I told them to auto center this. If I lock this, oh, maybe the lock does it. Let's see. Let's see if that works. We have this weird effect where there's 2 DOMs, so that's one of the things we're working on. All right, let's see. We got SPY coming through, QQQ coming through. Where's my liquidity maps? Let's go. Let's go. All right, we're sitting here to talk about really quick. We're in a DD float situation where you got to make sure that we do not break the DD band to the low side today. That'll immediately trigger an irrational market, so I wouldn't be doing anything. If we do touch that, you want to see with that DD ratio being as positive as it is, or as bullish as it is, us float off that lower band. So keep an eye on Nasdaq and S&P for DD float, okay? Float failure is one of the things we deal with when we watch. We have a thing right here. It's, you want to see it avoid touching the band. If you touch the band, you can't trust anything from there. So you want to see that thing kind of hang in there and be as clean as possible today. Let's go back to daily. Let's go to SPY. Okay, so we got mean reversion today on SPY, mean reversion on QQQ. Basically exactly what we've been seeing last couple days. Market is just sitting mean reversion. Let me here really quick. All right, we are trading below hedge pressure, so mean reversion is not a breakout trade, not a sell-off day. We're going to see if anything breaks to the bull side. I'd be willing to go long at 457. There's pretty much a no trade day today. QQQ is in that same boat. I actually drew my DD bands here on futures, which is pretty nice. I have this right here. Everybody, if you can do me a favor, make sure you go in there and like the stream. Do me a favor. Click that like button below the stream. Help out that YouTube algorithm. Give us some love. Would appreciate that. I think this lock is centering everything, which is good, actually. Okay. So that actually did that. That's good. Let's see if I can show. I don't want to show the actual volume. 1.0 DD wild, man. It's as bullish as it gets, baby. Don't get any more bullish than that. Yeah, I'm ecstatic. All right, so no day trades today for me unless we do a hedge pressure break. We're going to be very careful. We're going to be watching these lower DD bands, make sure we're not going in there tapping them. So with the DD number being as high as it is, again, still as bullish as it is. I don't really have much fear of this. Okay, let's look at the resiliences. The S&P resilience is very negative, so be very careful. This is resistance off a half gap. And if you're outside the box, it's resistance off the box. It's not going to be a long day today. unfortunately. So today I'm going to let the market relax, but I do know that when I open in the middle, the highest I expect is a bull zone tap back to here. So there's really not much upside anyways. I think I'm going to kind of chill today. On swings, I want to bet that the market doesn't become irrational and unstable. Why not trading hedge pressure on QQQ? Because the S&P resilience is negative. So let me draw out all the pieces of this really quick. So when you have negative resilience, let me show you what the different pieces are. So mean reversion is just middle, wall to middle like that. Yeah. So wall to middle, you see that. Oh, wait, where's... Oh, it's not going to show the liquidity. Oh, let me let him really quick. We need a liquidity map. Widget. Pop out charts, please. Just notice that. Well, I have futures over here. So if you see right here, I have futures. So there's no liquidity map for futures. Each of the child charts here are going to need liquidity map option as well. So let me use the big liquidity map. So it's the little things we notice as we're ramping them up, releasing the platform. I'm so excited about futures. Guys, I'm like extremely ecstatic. Okay, so just understand that anything that's MR, liquidity pocket here. MHP resilience is showing, but what we've noticed is that there's a bug in the equation that allows the condition that every single stock is above monthly hedge pressure or below monthly hedge pressure, and neither stock is breaking hedge pressure. It just shows it's 1 divided by 1 is 0. It shows no change in hedging or flip-flopping. So what we're doing is we're modifying the equation to counter for this effect. The effect of when everything is bullish, it comes up with no change. It's very interesting. Yeah. So we've been analyzing what this is, and the data looked good, and we're like, oh wait, all the stocks. No stock is breaking monthly hedge pressure. So it's not triggering a portion of the equation that's making it 1 divided by 1, which makes it 0. Very weird. Monthly resilience. So it's the yellow one. But either case, we're not even close to monthly hedge pressure, so it doesn't even apply. This is the tiebreaker when you're at monthly hedge pressure. As we know, it's like way off the charts anyways. So that's what I told him. I said, you know, we're not in a hurry to fix that. Let's fix futures and then get to that second. But yeah, you guys, thanks for reporting that. It's an interesting phenomenon that basically 0 and 100 are the same thing. So it's either going to be all pressure up, all pressure down. And when it's, anyways, I did the math. I ran the equation manually, and I was like, oh, that's why it's 0, because everything reduced to this. I was like, oh, that's why. That would explain why it's 0 and not 100. And that's a flaw in my design for this one particular case. And it's again, you're pegging out DD's almost 100%. You got the same thing almost every stock in the Nasdaq above its monthly hedge pressure, things like that. If anything seems frozen, just refresh it. This is one of the things. Let me go ahead really quick. Oh, my chart is definitely freezing. Make sure I'm connected. Also, as we're noticing, as we're adding more things to the platform, zapping a lot of the memory in the browser. So after we release futures and after we release our rhythmic connection, which is going to be next, and all you guys can do your trader funding programs. You know, I've been hearing through the pipeline, not going to dog any of my competitors here, but I've been hearing through the pipeline. There's a lot of platforms out there that people use trader funding programs with that are shit in the bed and like lagging out and cutting data, and people can't even access their accounts. Well, you're going to welcome Rocket Scooter to the scene. We're going to be an alternative to the popular trader funding program platform. You'll be able to come trade all your trader funding programs here in our platform. And we're going to commit to stability and making sure your data doesn't freeze up. And we're going to optimize the platform like you wouldn't be able to imagine. Our futures right here. This is our futures environment. This is our equities environment. So if something seems frozen, make sure that you are connected. Just click this button right there. And make sure that you are connected to all your things that have not just refreshed the platform. So I'm excited to go out and create a better environment for those in that situation. Okay, so let's talk about mean reversion really quick. Let me show you the different parts of Rocket Scooter. This is how we read the market. Like I said, I'm not too eager to go in and do a lot today, unless I get a better sign. You tend to push towards the middle in mean reversion. DD has this effect, and we have cheat sheets for all of these. For those of you that have signed up, check it out. There's gonna be a cheat sheet for each one of these things. Let me put this over here. Okay, so resilience being the first one. If resilience is negative, which it is, -6, you're inside the box. It tends to push towards the lower side of the box. Okay, so we're going to draw the line that if resilience is negative, this play is possible. And then if res goes positive, that play is possible. So liquidity map is here. Shows a press to the middle. Resilience is resistance there, support there. And the last part is the DD band being, DD ratio being so high. Again, like it has been, all the stocks are stuck in bull zone. Opening in the middle, the upper band is preferential to tap below the lower band. So that upper band, I'm sorry, the upper box is preferential. So DD is a trade right to there. So basically, I'm expecting the market to move up and then down and stabilize in here. Okay, as long as res is less than 0. And I think that move is just now taking place. This is exactly what we see at the open. Let's go here, right? There's that move up to the upper band and then down to hedge pressure. Sorry, down to the middle of the range. And that's how this works, right? I'm just looking at that specific pressure, and that's it. Not really long from here. 457 break. I would be very long though. So we'll see if we get something great there. I'm gonna wait this one out. So I don't really have any great sign that I'm gonna want to take any longs from here, at least on the S&P. Let's see what IWM is doing. The whole config is looking sexy. Well, thank you, man. Appreciate you. All right, IWM is a bull long up. Let's pull that up in the liquidity map. I just made a note to him that to my developer that we need to add the liquidity map button to the side charts. The next thing, so I can click and have the liquidity maps here as well. The alerts are there. Oh, that's great. Do y'all like it? It's looking good. And guess what? The platform's about to get its own design overhaul as well. We're redesigning the platform. If y'all have not seen what the new redesign of the platform looks like, just the look of it, let me show you. This is exciting too. So we have a bunch of neat features coming out, not only features, but this is the actual new redesign of the platform itself. Like the look. Tell me if you guys like that. This is from our Figma, but this is exactly what the overlay of the platform is gonna look like, and it's revamped. And this is coming out this month too. You guys like it? Yes or no? Up or down? More streamlined, more laid out. Pretty? Is it terrible? Is it horrible? Is it great? Better fonts, easier to read. It's redesigning a lot of the things that we went through the wish list and all the things that everybody were like complaining about or didn't like. We went through, yeah, bigger fonts, more spaced out, easier to see, easier to convey the information, better colors, cleaner. Yeah, so this is what I'm saying. You guys supporting, the effort and development here is we're listening to everything y'all are saying and trying to make it look cleaner and more beautiful. Optional dark mode. Yeah, this would be the dark mode. Maybe have like an optional light mode. That'd be kind of cool. Yeah. Awesome. Well, I'm excited about the new release. Somebody said we need to work on the multi-charts. Yeah, multi-charts, you just pop out multiple windows of charts. So, and lay them out on your screen. If you have any improvement suggestions for multi-charts, let me know. Okay, here's how BLU works on Russell. Let me show you this. So on Russell, the way I'm looking at BLU, if I support at the open, it trades to next resistance. If I lose open, then hedge pressure supports on Russell. So essentially what this is Russell opens here and trades to next resistance. Well, there's your resistance. If we lose the open, which we're doing, then it's potential to pull back to here today, and then it's a long of hedge pressure. So in reality, you know, there's options. Either I think we're going to support a hedge pressure on spine that the float's going to hold. Russell could fall a little bit further today. If one were a maverick and one were believing in this market today, betting on DD float is not a terrible idea as well, which I might actually make my first trade on that. The DD ratio being greater than 0.5, I expect us to not want to touch that lower band. Now again, Nasdaq's the one that's going to tap first, so we'll keep Nasdaq in the vicinity and make sure we watch that one. Actually, let me put Nasdaq here. NQ star. Hold on, I'm getting used to doing this. Another thing is I'm gonna change the NQ. Hold on 1 second. MNQ. Oh, that's indicators. Okay, that's why it's not working. Okay, can I not change the ticker here? Oh, because it's open there. Okay. All right. Let's try that again. Let me try over here. Okay. Let me figure out why I can't open. Okay, I think. Why is that not opening? I'm talking to myself. Okay. Try one more thing. I'm trying something on the Jolts coming up soon. That's correct. Okay, for some whatever reason, I'm not able to load up. Maybe it's just my platform. Okay. I was going to try to get Nasdaq futures up as well, but I think it's because... Oh, wait, I know. Oh, wait. Oh. I know why. Okay, so here's one of the things I was experiencing. One of the things that we are working on. So essentially what I was trying to do is get futures loaded up over here. Currently you can only have futures in your main window because each one of these is a separate session and we can only have one API or one socket connection for each user for security reasons. So we're going to have to create sockets to connect futures. But basically, I was trying to search for futures to open a futures chart in the child. We call these child charts, the small ones. Currently, futures is only available in the main window. That's why. Yeah. That's why. Okay. So I'll just leave. So I can do here. I'll do in Q. So if I do, that's why. Okay. So E and Q. Perfect. Okay, let's do this. Nasdaq futures there. Let's draw the DD band on futures. That's going to be 15,753.25. 15,753. Right here. Okay, good. That's good enough. So what I might try to do is we're going to watch Nasdaq today. Make sure that we don't break through DD band. And Jolts can make them just a little bit. So everybody make sure that you don't miss this. Jolts can be a big deal today. And I might want to take a long as we approach that DD band, but being careful if we lose it. In just a little bit. This is today. Coming out in 9 minutes, we got the Jolts. So 10 minutes. If we get a quick dip, I might want to grab some contracts right off the dip, maybe a couple micros. Yes, star. Get all the contracts here. This is September. Oh, nice. Save my DD band. Perfect. That cough she has been lasting very long. Oh, I know. We have allergies from our cats. We're going to have custom coloring for a few tabs. Oh, for the design? Sure. Wisdom King. So daily res, are you talking about the monthly hedge pressure res? The yellow one? I explained that earlier. There's a specific case in which this is happening in this DD being 0.99 in 1 environment, where the calculation is reducing itself to 1 divided by 1, which makes it 0. I have to create a custom I think how I have to create something that accommodates for this case. To tell you what this case is to reveal a little bit more how the equation works. Right now, it should say close to 100 or like high off the charts. Like monthly res, monthly hedge pressure resilience should be close to 100 or 100, yeah. When we pop out different charts, we'll be able to open separate DOM each chart to trade simultaneously. Currently, no, not yet. You can only have, in our platform, you can only have 1 DOM and 1 connection. To have separate DOMs open, that's a whole nother challenge. And we're not going to go that route just yet. At least in our timeline of what we're releasing. You just have to trade in your main window for now. But good question. What's the indicator? And the reasoning for that is because like the exchanges only allow you to like connect 1 time. So this is considered a connection. To create internal connections to other windows, we'd have to reprogram this to have this all internal. Like essentially, this is your connection to the data. We'd have to have you connect this to that. So we have to build internal connections to fuel a DOM. It's not just like I can take the DOM and take the connection they send. We can't just, you know, split it in 3 different places. It just connects to the software application. So we have to internally divert the data to your other windows. It's a big challenge. And in all honesty, we're going to pivot before that'll be a future release for sure. But we're going to do something even different before we do that. So eventually, yeah, you'll be able to have separate DOMs open and pop out a DOM and have individual DOMs. But for now, just the main window one, yeah. We actually discovered that this week with the release. The pop-out charts were opening separate instances of the DOM. It was doing that. And then that's why for the last week we've been delayed on the launch, because we're trying to figure out why it kept kicking me out of the platform, or of the futures connection. And it said every time I'd open a chart here, it would kick me out of this one. We'd open a chart there, it would kick me out of that one. So you can only have one open at a time. The separate window registered as a separate connection, a separate software application. So it's a programming challenge. This is just me chattering about programming. But yeah, so one eventually, yeah, but we're gonna make our own DOM eventually. In our next project, we're gonna scrap this anyways, and then start it. And we're gonna scrap this and then actually make our own from scratch. And so that'll be fun. Okay. So it's gonna be out in 6 minutes. Just waiting for that. I got the Russell here, got the SPY here. I'm gonna make sure we're supporting above hedge pressure, and then things just stay fine and dandy. Jolts are gonna be a key indication to predict what the Fed is gonna do. Fed is talking about their little Goldilocks zone here. Let me read you something I wrote on Twitter. Not just my Twitter predictions here. But let me go back to... Let me read something real quick. We got 6 minutes until that 5 minutes till number comes out. I wrote something pretty interesting, I think, to take note of. Repeating the 1978 to 1984 market. Now, let me just show you what that market looked like, okay? Actually, let me zoom out. Okay, you had like a recession, kind of sell-off bear market, and then you climbed and sold and climbed and sold and climbed and then sold, and then the biggest rally we've ever seen, okay? This is like a 4-year period right in here. And during that time, our market equivalently is like right here relative to tops, okay? Now, again, I hate using the past to try to predict the future, but this is the same economic situation. During that time, you had a yield curve inversion, so the 10-year treasury constant maturity minus the 2-year. And you can see when that's negative, it means there's less demand for the 2-year treasury, more demand for the 10-year treasury, which is why there's a difference in yields. This is negative as well, and bear thesis love to grab onto this yield curve inversion as like signs that the sky is going to fall tomorrow. But in reality, this preceded a 16-year rally. Now, the yield curve, or the shift, is usually seen in bear cycles. One can see in the 2000 recession, we moved like this, right? People tend to, let's see right here, I think this was like 1990. This is 2000, so this was the market crash of 2001. You see how it rallied like this? This was that last market crash there. This is the big market crash you had in 2008. This is coming down. There's less demand for the 2-year treasury, which means people in the short term aren't fleeing to safety. And during that time, you can see the Fed was also raising rates aggressively. I'm talking aggressively, leading up into the 80s. And then they started cutting. Same thing we're experiencing now. And during the time the Fed is raising rates, the market is just slowly rallying. You breached highs and then sold off for a year, and then the market just steamrolled and the rally didn't stop. You had a baby at the beginning of the rally. Your baby graduated high school in the first market pullback. Okay, that's how long it rallied for. And S&P went from 100 to 1600 after that. And this is during rate hikes, and this is during yield curve inversion, a bunch of other things. The market has that same similar feel to it. The Fed is trying to raise rates to curb the inflation, but not trying to move it too far to collapse the economy. Okay, and so basically the Fed doesn't want the market to sell off, or else everybody becomes unemployed again, which is what we're going to talk about the Jolts today. And I've seen this Cheech and Chong ad for their gummies literally every other post. I'm sure they're delicious. But dang, guys. Literally every single ad. Okay. The Federal Reserve Bank of Chicago president, Goolsbee, said that they haven't made up their mind about whether to raise rates or stop raising rates, emphasizing that nothing's off the table, so they can go either direction. The Fed's goal is to stick on the golden path, which is like the Goldilocks zone, and get inflation down without causing a recession. Okay, so the idea is if they raise rates too fast, it can have an impact on the economy, and companies will start to reflect that. They can start firing people again and people get laid off. And if you get high amount of layoffs with inflation, it's called stagflation. And Fed wants to initiate a period of quantitative tightening, which is letting things roll off of their books. Also has to do with probably the yield curve a little bit, but think about this, right? If the Fed wants to enter QT, when they raise rates too fast, which are two different things they're doing, and the market crashes, then they have to enter QE all over again to pull us out of the recession like they did in 2008. The Fed does not want to enter QE. They don't want to put stuff on their books, like treasuries. Clearly, nobody wants them. That's why the yields are flipping around, especially in the short term. The Fed wants out of the treasury game. They want out of everything. They want to, not everything, but they want to let their, a period of tightening instead of easing. So if the market crashes, they're back to easing. They don't want to do that. So they're not going to press rates too hard that Wall Street flips out and starts selling everything off. The markets crash again, and then people start getting laid off. The Fed's got to come to the rescue. So they're not going to crash the stock market with their actions, exactly what they're saying. So let's watch the Jolts. Jolts just came out. Should be right now. Okay, its first numbers came out. The ISM manufacturing PMI came in at a slight miss. The manufacturing prices came down a little bit, which is pretty decent. Looks like we traded down and right back up to where we started on futures. So that is a non-event, which is pretty decent. Non-events are great. Gonna sit out on this one. So no effect on the market. Let's see if the Jolts come through. I'm not getting a report on that yet. Go here. Not going to take any action off of this. This is a non-event. Data's not coming through just yet. That's going to be the big mover. So anytime futures move down and up or up and down, you return to where you started. There's no effect on the market on the. So let's see what the Jolts come through. Let's get that number. There's a little delay on that. Okay, I'll keep that on the side screen, just watching it. What's the indicator for DD band? We don't have an indicator for it yet. That's coming out pretty soon. And these will only be available for Pro Plus. If you guys are in the $35 a month extended trial, you have to upgrade to the Pro Plus package to have this launched. We're going to push this live starting tomorrow. As soon as the DOM situation gets fixed, it should be tonight. Then that'll be tomorrow's for the release. The DD band is the next indicator we're going to make. We should have that done in about a week or so. So next week we should be getting those alerts, those indicators here on the chart, the future charts. Jolts just came through. All right, take a look at the data we've got. Jolts are lower. That's great for the economy. Again, Jolts coming through lower shows that we're still hiring people to go back to work. Love it. Now again, just a slight miss. A slight beat, but still, the overall month to month is trending down, which is great. You have job openings coming down, and tomorrow's Thursday's economic data reflecting the unemployment claims. Will hopefully reflect that as well. We see continual unemployment continuing to trend down while the Jolts are trending down. It means companies are hiring people back with a lot of the stock prices at all-time highs. You can imagine some of the companies don't feel too pressed to not hire people back. Especially at the dip a couple years ago. There's a lot of stock buybacks, and people executives and a lot of these companies made a lot of money through buybacks, and this happens in a recession. They buy their own stock back at a low, and then they infuse some capital back into the business, and now they have some working capital at the high and go hire some people back and get their business going again. It's good. I'm just loving it. All right. I don't know if I want to take any SPY press to the upper. This is where you get for DD trade from hedge pressure to upper band. As we know, right? That's a pretty decent scalp, but it wasn't really worth taking because there wasn't much room to move. So now we're just going to kind of like keep our eyeballs on the actual market itself. I do like what I'm seeing. Let's just test a micro since we're breaking a bull zone. Resilience is good. Let me just trade one micro. How's this work? Marketplace, market filled. Okay, let's make sure everything's showing up. Profit not showing anything. Okay. They're just testing this out right now. Make sure everything's nice and clean. Go let him know this really quick. Doesn't show anything. So, actual micro future 1 MES micro contract. I'm just testing out live just to show you what it looks like. All right, resilience is positive, right? We're in the bull zone, trading to upper band. That's probably going to be a nice little scalp to take. I normally don't jump into trades on the bull side like this. Usually in mean reversion, we expect it to close in mean reversion, so it's pretty short-lived. Just a couple micros to fill the upper band. As long as rest stays positive, I'm pretty good for that. But again, a micro, so my stop loss is if we lose hedge pressure.
We switched.
Although it's not showing my profit, so that's one of the things that I need to have fixed as well. Good to see that. Shows my position here. Shows the position on the chart. That's pretty cool. All right, I think I'm pretty satisfied with everything in the live mode. It's working pretty good. I got a fill. The fill was instant. Looks like I got I do like the interface. It looks good. So we're gonna repair this part. We're gonna obviously show the profit of the trade. That little box is missing. And then let me turn off trade settings, instant order display. Oh, so I can get rid of trade notifications. There we go. I like that. All right. Let's test. Oh, there we go. I didn't want to buy 11. Okay, that was weird. Okay. That's certainly a bug. Okay, we're gonna work that out. Let me refresh and make sure that's just not a graphical thing. Oh, never mind. That's just a glitch. Okay. So that was interesting to see that. All right. Let me make sure I'm 1 and 1. Okay. I was like 11. Okay. We're going to make sure we fix that so no one has a heart attack. I refreshed and that fixed. It's all web interface. Oh, that shows my profit on the chart. Profit there as well. Okay. Refreshing. Fix the profit. And fix the quantity. But live, they didn't update. Okay. Very cool. It's all web-based. Yeah. So should trade settings, instant order placement. A couple of things here. So when I save my layout, I also want to save these things. These are all things that you can't, obviously you can't test till markets are live. So it's good to see. Good to see it all like this. And also want those to save as well. So when you save like your overall layout, then it should remember your selections. This doesn't seem... Okay. Can you also buy on the chart? I think you can. Let me see. Create new order. Yeah. Looks like you can. This is cool. So we'll check this. Okay. Just what happens if I flip between charts. Right, a hedge pressure right now. Let me double check that that doesn't create like another glitch. How about one more micro? That's just weird. No. This is just a calculation, this profit. That'd be nice to make $59,000 in profit. Okay, let's flatten position. Okay. Give me 1 second. I'm gonna copy this in the console really quick and then send this to my developer. All right. right. All right, we do have a DD float failure today. Just everybody make sure you're aware of that. So a DD float failure is where you actually touch the bottom of the DD band. That is not the best sign in the world for today, at least rallying, moving higher. I don't trust anything from here, so the market can do anything. Don't trust anything you see. When that DD ratio is so high and you have float failure, it's one of those things that don't trust it. I don't see this and say, ooh, I want to short. I don't see any green and say, ooh, I want to long. This is a classic sit out day. That's why I just liquidated and closed out those micros I bought. Doing nothing. This can go randomly either direction. Sometimes it rallies all the way back up to the top. Sometimes it collapses and sells off. So today we're gonna, okay. All right. A little bit of bug troubleshooting and bug testing. So the rule with float failure is that when the DD ratio is bullish, I'm gonna pull up the graphic really quick and show it to you. The market is not going to detach so much from the bullishness of the stocks. That long pressure of the stocks is going to want to keep the futures market from collapsing. So usually there's just kind of like this prevention of it just even touching that risk interval band. And what happens is when you do touch it, don't believe anything you see after that. As a matter of fact, in the DD float video that I teach here in Rock Suiter Discord, you can see even in the middle of the video I was teaching and the market was like rallying when it actually touches the band. The market gets weird from there and very unstable. It touched the band and all of a sudden it was like green, 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 green. In the middle of the video, I was like, you can't trust anything you see. A red candle came out of nowhere and the market collapsed that day. And it was kind of fun to watch live. So what it means is that the market's just irrational and you can't trust what you see from here on out. So you might see a bunch of red candles and you might say, this is the day market crashed and I'm gonna jump in and chase the short, and then it just rallies for the rest of the day. The market's detached from futures. The equities market and futures market detaching is not the best sign, and the market's going to respond very violently in any direction. A 10-year bond rate north of 4. Honestly, I'm one of the few people that sees that when you have guaranteed inflation and guaranteed rate hikes and a guaranteed almost repeat of what happened in the 80s, just people know that fixed income is just not the bet they want to take. The yields are rapidly changing, especially the short-term yield going way up because nobody wants to buy short-term notes. You have inflation. The stock market not collapsing, everybody's rushing to equities and not buying treasury bonds. I mean, if the Fed doesn't even want them, you're going in QT and there's a high period of inflation, rate hikes to turn it down, why do you think investors would want them either? Yields go up when premiums go down, and premiums go down when demand goes down. So if the 10-year or 2-year inverted where the 10 minus 2 is negative, it means the 2 is greater than the 10s. It means even demand for the shorter term yield, short term maturity is even lower than the longer term maturity. So you usually see that in periods of hype markets. Okay, so just showing what the rule is with float is what you want to see for a stable market. Typically, when the ratio is so high, you're not going to want to see futures markets touch the lower DD band. And if they do, then the market gets a little chaotic from here. You can see that, and I'm going to show how there's unusual volume, unusual volatility. You can see it right here. You see all this extra, like the minute you touch the band, the volume just spikes. I mean, it's almost as high as the opening volume today. That's pretty normal when you have a float failure. Okay, so Nasdaq losing DD band. Now we're also going to have the same effect over here at the S&P. The S&P starts to get lower, and if you don't reject and immediately pull off, you can start to have unusual activity. And from here, the market is purely random. Float is like this. You see how pre-market, while there was selling, there just seems to be some pressure that's pulling off of that. That's what float is. The stocks are bullish enough, they're gonna get enough long-term pressure that the market's not gonna reward shorts, and they're gonna know they still need to raise the price, and that's what that means. But if the selling pressure is too much and you overwhelm that level, then the market's just random from here. Look at how much crazy amounts of volume come out of nowhere when that happens, right? So it's not a long, it's not a short, it's not a anything. It's just to kind of sit back and observe and watch what happens. We got to take everything with a grain of salt going forward. This is the actual float itself pre-market. Let me show you the graphic real quick. So when you have your bands, without a catalyst or an event, it usually is really hard for the futures market to break DD band overnight. It takes a huge selling event in other markets or whatever. And you see how we were trading down and it just got really close to the band and something kept it from touching. Just touching is enough to destabilize the market. The act of touching it creates this unusual effect. Anytime you touch DD band, it creates an unusual effect. But float has to do with, the rule is when the DD ratio is bullish, the market prefers going to the upper band, not the lower band. Okay, so today, with the DD ratio being 99%, the market would rather go here than there. The idea that the selling pressure is hard enough to go against all 500 stocks in the stock market is weird. And you have to always just assume that that's weird behavior. And unusual weird behavior is accompanied by unusual weird volume. We always talk about the volume being like this inverted J shape, or say this J shape as the course of the day progresses. Volume's usually high at the start of the day and then decays and then gets higher towards the end of the day. Unusual volume midday that's even as high as the open is evidence of weirdness, like we say, unusual activity. So we know that the rule is if you touch the lower band when the market doesn't want to, DD ratio greater than half means that it does not want to touch this lower band. It's got to fight its way there, and it fought its way there over the course of the morning. When you touch it, when it doesn't want to touch it in that scenario, then you don't trust anything from here at all. The market's going to detach and unwind very quickly, this unusualness, and things are going to snap back into place. The stocks are still really high relative to the futures and the index. So the float failure, I don't see this as like, ooh, let me chase the short. I'm finally going to see the market crash. I don't see those red candles and say, okay, market's going to collapse. I don't see this and say it's going to collapse. It can. It can very well do this. It can very well do that. It can do anything, and it's very hard to determine from here. So any trading from here is just good risk and reward. If I'm trying to long any reason at all, I just have to make sure I use good risk and reward. But I know volatility is going to be there because unusual activity usually comes with unusual volatility, and the VIX is trading slightly higher because of that. So, you know, with our swing trade, you're going to want the VIX to be down here over the course of the month, and a day like this is going to keep that from happening for one more day. So it's kind of delaying the inevitable for another day. So is this a long to buy on? Do we rally to higher highs today? It's going to be very hard to determine, and in reality, you need the market to kind of you have to take what you can get in environments like this. So in a day trade, if I were to take a day trade off of something, which I really have nothing to trade off of, especially in the S&P, I'm only trading to next resistance, and that's it. Like I would scalp to there. If we broke through here, I'd scalp to there. I wouldn't be taking directional plays because the market's going to be choppy and whipsaw. And it's almost a guarantee on float failure that you're going to whipsaw and the market's random. It's like it's 2 p.m., like that rule. 2 p.m., the market randomly pivots and does something completely off the chain. It's like the 2 p.m. rule just now happened. Yeah, I would say so. Let's read the monthly maps and just see what we're still looking at. See how the monthly maps, the bull side is still hanging in there strong. The bear side is starting to creep back in though, as shorts are going to start picking up right at the first week of September. So any blast up rally, if we're expecting one, is going to happen very soon between here and September. So if this is the day that stabilizes and this is the last day that stabilizes, we should be good. Super excited. Oh, my bad. My bad here, sorry. So on the monthly map side of things, let's go ahead and run monthly maps on both Qs and both S&P. Take note that there is a slight inflection change that is having me see the market slightly differently. The bull side is still hanging in there over the course of time. Same thing with Nasdaq. I mean, it's just extremely bullish over the course of time. As that slopes down, market's bullish. Now let's monitor what's going on with the bear side. So I'm going to trace the top of the bear zone. See how the bear side's also liquidating over the course of time. But right about here, there's a second kind of wave of bearish positions going more long while bullish positions going more short. That's a period in the commitment of traders of liquidity. So when you draw a line like this, you have bull and bear both going up. That's a twofold rally of illiquid market. This is the COT. I'm converting that to direction. Illiquid market. And then from here, you're going to have a stable period where shorts are becoming more short, longs are becoming more long. So again, that's a liquid market. So essentially, my theory is that what this is going to make the S&P look like is the S&P is going to stabilize here. It's going to rally very quickly into monthly expiration. And then it's just going to hold through this period. Now, one of two things can happen. If the bull side starts to liquidate, you can get panic selling off the double top if this green line starts to inflect up. If not, it just holds. But I'd like to err to the side of the market's going to probably respond by selling that double top for maybe a month at the most. But with the bull side still waiting to be bullish all the way through November, any 1 month dip or so is going to be very short-lived. So in the worst case scenario, what I do believe is going to happen, worst case scenario is that, we rally, double top, drop really quick, and then, finish off the year pushing higher. I don't know what you guys think about that. But that's what I see in the S&P. Nothing is alarming in the immediate term, okay? Even like little catalyst days like this or little event days like this, nothing is alarming the positions. Even in Nasdaq. Nasdaq's looking very clean too. What's up, dude? Nothing much, man. Just testing out live futures trading. Ralph Budd, the answer to that question is absolutely yes, because price in a bull zone means there are calls that are in the money. It doesn't mean that everybody's longing the stock who's recreationally buying or speculative buying. It's that there are options that haven't expired yet with calls in the money that were sold to traders. Those call sellers have to be bullish. It doesn't matter if price is falling, rallying, flat. It doesn't matter if it's in a bull zone. Somebody must be longing that stock in case they're assigned that position because those options are in the money. That's correct. As you have nailed with the formula is going to show you that every dip is going to get bought up, Ralph. And doesn't mean that DD is not to be seen as market is bullish on your trade today. It means someone has to buy, which means bull zone is support. That's what the rule means. You have to stop thinking about indicators like technical indicators. You guys get your brains poisoned by all the technicals out there that say, oh, when resilience is going down, it means the market's trading down. That's not what it means at all. I mean, DD is going up. It means the market must rally, right? That's not what it means. It's not like oscillating indicators. What bullish DD means is that this cheat sheet gives you the only cases that it applies to. Okay, let's talk about it. DD ratio bullish. If you open in the bull zone, it supports at the bull zone. So that didn't happen. If you open in MR, which we did, it taps the upside of the bull zone. Check. It did that. Exactly what it shows right here. If it opens BR, this doesn't apply. This doesn't apply. There's only one case. And so it preferentially wants to touch the bull zone. That's the only thing it tells you. The stocks are bullish enough because they're in their bull zones that delta hedging will show people will be forced to long the stock despite markets selling off or not. The further they sell off, the cheaper it is for those call sellers to buy the stock. They still got to buy. Monthly maps is how to accurately interpret them. Is cloudy? No, it's 100% a science. I will walk you through the process. There is no way to misinterpret this. There's only one way to do it. Ready for this? I'll give you the lesson very quick. Now, this is going to be harder to see because you don't see... Let me just go to something easy. Because you're going to see a lot of stuff in the S&P. Let me pick a stock, right? Okay. Michael, we should. Okay. Let me pick a one that's going to be easy for the lesson. Okay. Is Disney looking good? All right. You identify bull and bear zones. The algorithm tries to do it for you. Now, the bull zone, you always trace the bottom. The bear zone, you always trace the top, just like it shows here. Okay? This is basically it. You have 4 different things, bull and bear. Okay? If the bull zone slopes up or the bull zone slopes down, and the bear zone slopes up and the bear zone slopes down, these are the things you take from that. Okay, ready? You guys take notes. It's pretty straightforward, but maybe I can make a better video.
Your team's not in the same place. Your work can
Okay, YouTube. Dropping them ads. Okay. And then bear zone up, bear zone down. The bull zone is sloping up. It means bulls are selling, so longs are selling, okay? The bull zone sloping down, longs are buying, okay? This is very, very important to understand the difference between the two. The bear zone is sloping up. It means shorts are shorting more. The bear zone is sloping down. It means shorts are covering. And that's it. That is literally it. One secondary behavior is that when bull and bear are fanning out from each other, it means volatility, or your implied volatility on your contracts, or volatility in general, is going up over that period. If your bull and bear zones are pointing towards each other, it means a tightening period or volatility is going down, or which means liquidity is going up. Liquidity and volatility are inverse. Are any questions? That's it. That's monthly map. It's predicting sentiment change and positional change. Any questions so far about that? Be sure everybody's on the same page. So Disney, let's piece it out. You literally Write this down. Take a screenshot. Write it down. Yeah, no, I got you, Drew, bro. I got you, man. Sometimes my videos go winded, but I give you the short answer. And thanks for bringing that up, dude, because I want to make sure you guys are always knowing what's going on. Okay. So sometimes it's going to be messy, like the index chart's kind of messy, and sometimes you're going to see things change. Every day we rerun it. So here's an example with Disney. The bull side is sloping up. It means longs are selling. Okay. So longs are selling. Bulls are becoming less bullish. Bulls are liquidating their position. With the bear side sloping down, shorts are covering. So longs are selling and shorts are covering. So essentially, notice the difference, right? These are people exiting the trade and going to cash, right? These are also people exiting the trade. This is kind of a neat way to see it. Fewer people trading Disney. Longs don't want to be long. Shorts don't want to be short. Nobody wants to touch it. Either side. Shorts shorting more or people entering the trade. This is enter. Right? These are people adding to a short position. Bears becoming stronger. These are people entering a long. Bulls becoming stronger. Okay. So the two things to take note of is bulls are exiting, bears are exiting. Both sides are fleeing, and when they point away from each other, it becomes more volatile. As you see, while Disney is not bullish or not bearish, those tiny little trade days it's been exhibiting, are you having bigger waves up and bigger waves down? You see that? Disney was just kind of slowly ebbing along, and now it's becoming more choppy. That's what volatility is. Volatility is choppier weather. Higher highs, lower lows. So this is showing you the volatility that Disney's having. It's not bullish, not bearish. This is the Rocket Scooter platform. If you get a link below, you can subscribe to it for a trial period. It's $35 a month to get this data for a trial. The size of the bars don't mean anything in our teaching. Now, this is such a new concept and philosophy for us. It can mean something. We just don't have anything for it yet. We're still figuring out how does the higher bull zone mean anything at all? And our initial thought is it doesn't. Because you're trading right here. All of these calls are out of the money, so they don't really mean anything to anybody, right? All of these puts way down here or out of the money don't mean anything. So what happens if the bull zone's really tall or really small? We don't think it means anything. What's really important is where the bulls and bears differ, and that's what monthly maps are beautiful about. Where your bulls and bears are facing off, that's what you care about. So Ashton is looking into techniques that can utilize selling spreads with the length of the bar, which is a very cool method, and he's pioneering that. And like I said, the more we play with it, the more we're finding out usefulness to it. But in general rule of thumb, what you're looking at is liquidity and volatility analysis, where bulls and bears are and where they disagree and how they're changing. Yo, what up, Sean? Thanks, man. Appreciate it. Long time coming, I know. Appreciate you, man. All right. Okay, let's do something a little more complicated. All right, let's put in another stock. Let's put in Tesla. What's going on with Tesla? Okay. Notice how there's a lot of, sometimes there's a zone, a bull zone, a bear zone. What happens when you see like zones start to creep in like this is because the sentiment's changing. So let's pretend that like 3 days ago that wasn't there and it just looked like this. You can see while the bull side is sloping down, longs are becoming more long. People are more bullish Tesla over these 3 weeks. And Fireworks, by the way, if you want to check out the platform and click that link below, all these training videos are available in the Discord. We're a new AI-based trading platform that's showing you positional data. This is market maker data. We've pulled back the curtain of Wall Street. This is market maker options positions. We cracked the code, figured out how to do it. So you can see where bulls and bears are positioned against the market. Okay, so bulls are becoming stronger, which means people are still being bullish Tesla over the next month. Bear side sloping down, shorts are covering. So you have shorts covering to buy, so shorts exiting their trade by buying and longs buying harder. So Tesla is 2 waves of bullishness, short squeeze and long buying. while Tesla is not rallying really hard, it's certainly not collapsing on itself under the pressure of longs and shorts covering. Do we see this? If I saw this on Tesla right now, I'd be more inclined to buy this dip to fill the gap up than I would be to sell this or short this. In my opinion, on my trade. Not investment advice to everybody, but does this make sense on reading the chart? Right? We good? Okay. Does that make sense, Drew? This is not the volume of the strike. No, this is monthly map is completely different. Volume of strikes and open interest in strikes is bumper bowling for toddlers. That's what everyone's been doing for 5 years. We graduated from that. And what this is an algorithm which is showing you mathematically bull and bear distribution, just pure risk. It doesn't matter the amount or anything. It's not volume. It's not anything related to that. It has to do with options pricing, and it's Greeks. A monthly maps cheat sheet? Well, that would be great. You gotta tell the lazy fucking CEO Rockscooter to get on that. He'll make it for you. Brilliant idea, SP. Ignore the size of the bars. Now, Ashton, unless you're learning from Ashton, Ashton has a technique on selling options related to these bars, like spreads. But as far as like sentiment and direction, the length of the bar has nothing to do with. In reality, your brain is only really caring about what I'm drawing right here. Where the bulls and bears are split and where the market's not bullish, not bearish. Okay. Oops. Okay. Let's do a couple more. So you see how I'm already, I see on the monthly map that while Tesla did gap down, is somewhat trading down. I'd be more inclined to buy Tesla from here over a 2-week swing than I am to sell. Bears are fleeing. Now let's talk about the little bar that crept in. You can see that this is like a new. So what do you do when you have two different zones? Well, you can use the highest one. You can draw it yourself. Now our algorithm is not drawing that. It's just a kind of like a flaw in the display of it. But your brain still does the same thing. And even though there's a higher bear zone now creeping up inside of here, it's still the same trend. Shorts are covering, longs are buying. That's how I see it. Yeah, we're going to actually make our own charts from scratch. At some point, we're going to build everything from scratch. And at that point, we can actually get the display the way we want it. There's limitations in TradingView and how you can project drawings into the future. Really not the easiest thing to do. So either we mess with that or we just go through our next step, which is make our own charts from scratch. Okay, let's look at the index now. Let's look at something messy. All right, the index is going to have 0 days, all kind of stuff. But in general, let's go ahead and do our best, right? Let's try to draw the bottom of these bull zones the best we can. And let's make it easy with a green line. Right? Here's the green line. Here's that bull side, right? You see that? General. You see that, Drew? So you tell me so far, what do you see about the bulls? This for you, bud. You make an assessment. You tell me what you see relative to what the bull positioning is doing. And when I tell you guys float failure is random, what did I tell you? You guys see that? How many people saw them red candles like, ooh, I'm gonna short, market's gonna crash. And what did the market do? Flipped out, rallied, and is actually the highest it's been all morning in QQQ. Do you see how float failure is random? It's all, and I say you treat float failure like it's 2 p.m. already. The market randomly pivots and those random things. Don't trust anything you see when you touch that lower DD band against that 99% DD. That's for you, Ralph. You see how there's still massive bullish pressure because calls are in the money, right? It just, and again, it's random. I just don't trade it. That's how I treat it. I don't trade it. Okay. Trending down, the sentiment is positive or long. Yeah, and so basically what this means, if you want a little bit more explanation, a very simple way to understand it is if you take time into account or time decay into account. Imagine that price stays exactly 456 over the course of time and doesn't move. And say that these options stay exactly where they are too over the course of time. As time progresses, you have more calls that are deeper and deeper and deeper in the money. And what happens if you sell a call that's in the money? Well, the person that bought the call from you can possibly exercise on you at any point in time up to that expiration. Therefore, you have to have that long position. So all of these calls that are calls sold by dealers to the dealers of the underlying, which are people that are engaged in the trade of the underlying against other traders, the call sellers are the ones that are going to be having to long the market over this period as long as price stays the same. Now imagine price stays the same. You have more calls in the money. Like on this week, you have 340, 360, 380 forced to long that very last week because they're in the money. This week, they may not do so because they may feel, well, I got a week left, you know, maybe I'll strike out of the money. But as you approach each expiration, you have more bulls forced, or more call sellers forced along, and even more call sellers forced along, even more call sellers forced along. So the bigger that distance is from current price, the higher the probability that there's just more people that'll be forced along. And that's why you create a sentiment indicator out of this, Drew, if that makes any sense. That's why the sentiment's long. Yeah, and it's delta hedging, right? The delta, like, check this out. Like, if price is here, and I've got 320 calls for that day that I've sold to somebody, then I'm going to be hedging not only, this is delta not changing, but I'm also going to be hedging theta as time decays. All the Greeks. So when we hold price flat, you know that we're holding delta flat. That makes sense, right? So when I hold delta flat, you can see that as time increases, you're going to have also changes in the time Greeks as well. So this is a partial differential equation, as you know. You either hold time constant and you vary price, you hold price constant, vary time. But either case, in a two-dimensional sense, the way we draw it is to give you this simple relationship here. And it'd be cool if we were actually like draw the words on the chart, like bulls liquidating, shorts liquidating, whatever, to make it easier to see. That's kind of a cool project, actually. The idea is just you have more calls in the money at the current price. All the Greeks are going to imply that there's more long pressure than short pressure. Now, let's take a look at the bear side of the market. So over the course of this amount of time, bulls are deeper and deeper and deeper into the money. People are buying calls to long the market at any price all the way down to here over this time. So the bull side is sloping down, the longs are buying harder. And who's buying? Well, the actual bulls of the market have already bought the options or bought the underlying. And these could be options bought by market makers to hedge their position to being on the other side of the SPY trade to the actual bulls. Either case, as they become deeper in the money, there's a higher probability that the closer you get to expiration, more longs appear out of the woodwork. Okay, so let's draw the bear side to make it even easier. Now, it's a little difficult to see, but, you know, just draw. Bear side for the next, you know, week is going down. There's an inflection point. It's going up. Then it's going down. Then it's going up. Then it's going down. Then it's going up. Okay? So let's break this into chunks. Let's start right here where it's very easy to see. Okay? Bull side going deeper, bear side going up. Okay, so you know that the longs are getting stronger and the shorts are also getting stronger as well. That's a period of liquidity where longs are buying and shorts are shorting. So when markets are liquid, they don't crash. That's one of the rules you can always write down. Liquid markets don't crash. They never do. Liquid markets. When you got bulls and bears are trading against each other, market makers don't need to drop the price at all. They've got a buyer for that seller. You only drop the price when you don't have a buyer for the seller, and you have to drop price till you find buyers. The rules of thumb, if you guys want to take some more notes, dealers are raising the bid and ask. Dealers are going to lower price to look for buyers. Okay, this is how market making works. Lower to find buyers. You get to quote the bid and ask. Well, you quote your bid lower. Or you lower your ask price. Either way, you're moving the bid and ask up or down because you're trying to attract buyers. You lower to find buyers and you raise price to find sellers. Like, this is the tenet of supply and demand. It's just basic supply and demand. You raise price to find sellers. Somebody doesn't want to sell their house. What do? You offer them more. You raise the price, and then eventually they sell. Right? I want your house, $1 million. They're like, no way. Okay, 2 million, no way. Okay, 10 million. All right, fine, I'll sell. It's basic supply and demand, right? Okay. So if sellers are selling harder and buyers are buying harder, then you've got a seller for every buyer. Does that make sense? So market's relatively liquid. So liquid markets don't crash, and sometimes they don't even rally. Sometimes they just stay the fort. Let me show you what liquidity looks like in the commitment of traders. I'll show you an example of that. This is a fun lesson. Just a quickie. Look on the bottom of my screen here. Am I blind? Oh, there it is. Okay. Let's look at the positional data in the S&P futures. This will give you a little bit more information. Liquid markets don't crash when buyers and sellers are buying against each other. Here's an example. This year's rally. This is the long position of futures. The asset managers are long. This is the long side of the market becoming more long. You see how it's going up? The leveraged funds, the short side, this is below zero, so the short side of the market. The short side is becoming more short. Sellers are selling harder, longs are longing harder. When buyers and sellers are buying and selling against each other, markets don't crash. As a matter of fact, that liquidity has been present since here. Liquid markets don't crash. You see how the bear market somehow just stopped selling off and it tightened up? That volatility tightened up. Liquidity is the inverse of volatility. We wrote that right here. So when markets are more liquid, there's no volatility. See how those big wide V's tightened up like that? You see that, Drew? It's pretty cool. That's exactly what we're exploiting in monthly maps. We're using options to even get ahead of this to forecast what that's going to look like. There's your liquidity when bulls are longer, which is this one. Bulls are longing harder and bears are shorting harder. Markets are very liquid, and liquid markets just don't crash. And there's no volatility. So in the futures positions, you see that same reflection of liquidity means markets don't crash. So when I say the market's gonna still rally and probably not collapse and find lower lows, it's because all through the rest of the year, at least in this particular area, you can see that the market's not gonna collapse. There's not gonna be volatile. So it's probably gonna tighten up and flatten out or drift higher. Typically liquid markets drift higher more than they sell up. But you can assume that it's flat or stable at that point, not unstable. Now let's look at this period. Overall, bulls are longing harder and bears are exiting shorts over the course of time. Now there's waves of bears are exiting shorts, shorting harder, exiting shorts, shorting harder, exiting shorts. But over time, at least until August monthly expiration, you see a general trending down of bears getting squeezed and bulls longing harder. Green line slopes down is this one. Red line slopes down with waves, but in general, it's this one. Shorts are buying, longs are buying. Everyone's buying over this period of time, and this is illiquid to the upside, where longs are becoming more long and shorts are covering. And bringing up the commitment of traders just to reflect positionally what that means. If the longs are becoming more long, let me just kind of... Let me show you how that should... Now this is actual price, the S&P versus the positional liquidity, right? So in periods when longs are selling and shorts are selling, markets trade down. Look how beautiful that is when they both point down. When they both point up, in a general period from here to here, and here to here, shorts are covering, longs are buying, and from here to there, the market started a wave of bullishness. And even so, in general, even in short-term periods, shorts are covering and longs are covering as well. Longs are buying. Buying together. Market's just moving higher. And that's what we identify with monthly maps. So what I'm doing with monthly maps is I'm forecasting that the longs are become more long and that the shorts are going to cover and that we're going to continue to rally through this analysis. So I'm forecasting, I'm predicting the commitment of traders before it happens, or trying to, using options data. This is a whole new paradigm. You guys remember back in the day? Hold on. When I was saying that the market would rally until July from the positional data, and then when June came around, I started telling everybody that monthly map showed bullishness until October. Well, that's because in July, there used to be an inflection on the bull side, but over the course of the summer, the bull side got dug in a little bit deeper. That's what we saw. So I made a tweet, back in like a month or two ago that said, newsflash, we're likely to rally until October. Just from this. And again, I could be wrong, but either doesn't matter. I'm looking at the positional data. I'm not even making a judgment call. This isn't subjective. This is exactly what this is designed to show you. I'm just reading this. I'm not adding any opinions to that other than reflecting what it's designed to show. So this is a brand new technology. So we're excited to share this with everybody. The monthly map is one of our best fun new tools. And it's useful for sentiment. It's useful for all kind of stuff. I'm glad you like it. Looking for SPY calls 3-8 weeks out. I can't tell you, John, on your trades. Fortunately, I can't give you guys any trading advice. We just make cool tools. I'll show you how to use them. You got to make your own assessment on that. Sorry. That's the one thing I can't do is tell you guys what to buy or sell or influence your trading decision at all.
This summer, try any specially marked 20-ounce bottle of Pepsi to get Apple Music for up to 3 months free. Can you say best summer ever? Ends 9/17/23. New and qualified returning subscribers only. Renews for $10.99 a month until canceled. See full terms at PressPlanSummer.com.
And one thing to take note on the Q's monthly map, you can see how that's kind of pushing all the way through the end of August, and then you're starting to see some bearishness change. Right? You're starting to see the market stabilize and become liquid. Now, through some of these upward waves, like I say, like right here, when we have a wave up and a wave up and a wave up, you can see periods of selling, which is why my thoughts, they change in my prediction, at least what I'm thinking, psychologically, is that once we double top, maybe through that first part of September, like the market rallies and double tops, and then we could just, we could get an inflection or catalytic induced selling where the market just, you know, kind of like drops for a month before it stabilizes. Like panic selling off the double top, right? Bears are starting, puts are starting to creep back in, so we'll see. It's liquid enough not to crash, so any selling would be short-lived and not so volatile, but we'll see how that works out. But it's making me think that it's not just a straight rally without a pullback. This little 1 to 2 month wave could be 1 to 2 months of selling. Maybe 1 month. It's like on the SPY daily chart. I mean, the way I see it. Again, like I said, this is just like, and this is the first year we've had this. Like first year we've had this to play with. So I'm excited to, like, you know, kind of like see how well it works. So through here, like essentially that we go through August and we double top, and then September like tries to fight its way lower and maybe fills this gap, maybe doesn't, and then that volatility tightens up around October and markets get stable. And then as we get closer, we'll get more visibility into the future, then I can decide if I think we're going to rally or not. As we approach, you know, August, September, we'll get a view of December. If that still shows bullishness, then December, January, February, we keep riding like that. If it shows bearishness and more volatility, then the market turns bearish again. So we'll have to see, right? You get like about that 4 month out clean visibility. We'll see what it looks like at that point, right? So in seasonality, that's kind of my prediction, right? And that's what I'm seeing, at least for now, in the position. Now, again, anything can happen. Markets can shift, sentiment can shift, and I'm basing, you know, my stuff on all the evidence. But in a general sense, the positions do show something like that. And the psychology of double topping is probably it. So, you know, my long swings over the next 2 months are betting on a double top. And as we start getting close to it, I'll be taking profit. So yeah, I'm in calls through September. 470s and 480s. That's it. And they're on their fire right now, and I'm still hanging in. You guys remember my big trade back in October? This is my second big trade of the year, or in the last year at least. So we'll see. If I'm right, I'm right. If I'm wrong, I'm wrong. Looking at CrowdStrike monthly map based on this discussion, looks liquid and bullish. I have no position. Let me see how you interpreted Crowd. Yeah, you're right. That could be some seasonality, right? Very, very, very astute. Yeah, so look at this, right? Bull stronging, bears weakening. CrowdStrike is very bullish. Bull's going longer. And less volatile and liquid and bear squeezing. You nailed it. And you can see the reflection of that is that it's just creeping higher and the volatility is shrinking as well. You can see that the waves here, right, are tightening up. Smaller waves, smaller waves. Big waves, small waves. And that's exactly what you're noticing. Look, there is no volatility. It's very tight. The space between bull and bear zone is a reflection of the changing of volatility. There's not expecting any volatility over next part of the month. So a lot of stocks are looking like that. And I agree. I agree with your assessment saying that you think it's bullish. It looks extremely bullish to me. And it's breaking out to new highs today. Very good. Very good job, Scott. I don't disagree. It looks like a flag pattern. My graphics card, my graphics drivers just crashed. Are we there? Are we back? That was really strange. All my screens went black for a hot second there. Let me All right, let me pause the stream real quick. Actually, it's a good time to call it a break. This is the end of the day. I normally stream until 11 anyways. Everybody, let's go to Discord. We'll be done. We will do a Zoom call in 2 hours, so I'll see y'all then. But yeah, make sure you head over to Rocket Scooter. I'm going to call it. I lost the buttons on my encoder. That's even broken. Looks like my graphics cards, my graphics drivers crashed today, but we'll see you guys there. All right, guys. Y'all have a good one.